There are a few times in history where our nation's economic status has been called into question, and for each of those instances, there was a legislative response. A 1907 panic led to the creation of the Federal Reserve. The Great Depression was met with the Glass-Steagall Act. Most recently, the Great Recession of 2008 was answered by Dodd-Frank. There has always been a cycle of enforcement and deregulation in the financial services industry, but this act took it further than most. The bill's reactive response to rein in the largest of financial institutions that were blamed for the Great Recession resulted in an unintended victim, community banks.
The Dodd-Frank bill was designed to deal with the 2008 financial meltdown. It was targeted at Wall Street, but in fact had a huge negative impact on Main Street.
Some smaller banks were involved in the pattern of activities that created mortgages doomed to default, but the majority were paying for the actions of larger institutions. The landmark legislation held all institutions accountable even if they were not part of the problem. In May of 2018, Senate Bill 2155, a major reform of Dodd-Frank known as the Economic Growth, Regulatory Relief, and Consumer Protection Act, was passed. This case study provided us with a framework to analyze the projected impact of this legislation and explore the real-world implications. Our bank partner, Kentucky Bank, opened their doors and their minds to us in the study of legislation and allowed us to envision the potential opportunity of future regulatory reform. Kentucky Bank and its tributaries began their commitment to community banking in 1851. Since its founding, the bank has grown to over $1 billion in assets and employs over 250 people in 17 locations.
Here we are in Paris, Kentucky, a relatively small community, and we have grown to become a publicly traded community bank. We're in 11 counties. As I've mentioned earlier, we've grown virtually any way that one can possibly grow as a financial institution.
Kentucky Bank has exhibited healthy asset growth over the years alongside a steadily increasing net income. Despite that healthy growth, like all financial institutions in the past decade, Kentucky Bank was impacted by the downturn of the economy and the resulting legislation. How it operated and served its customers had to adapt to meet compliance requirements. The Tax Cuts and Jobs Act in 2017 brought significant quantifiable relief for community banks. Kentucky Bank reported that with the tax savings, they were able to expand their community outreach by increasing corporate donations by 177% and increasing wages for more than 35% of non-executive employees. Hopefully, future reform will have the same positive quantifiable effects and will benefit community banks in all areas of the country.
We have never acquired another institution. We're not an organization that has grown through acquisition. We've grown organically through our markets, through our community's growth. In fact, if our communities don't grow, we don't grow. Current legislation creates some difficulties in our industry, specifically in community banking relative to the impact on our ability to serve our communities. One of the things that we have seen come out of the recent legislation, Economic Recovery and Regulatory Relief Act, is an open dialogue, one that has created an ability for us to engage with our regulatory agencies in a manner that hasn't been there as much in the past.
What I believe that Agrippa was trying to do was to find that threshold that said, this is a community bank, we would like to provide that economic relief to this particular section of the economy.
The larger banks were doing those trades, at a clip of 99% of the market, but we're really limiting then the smaller banks as to what they could do because of the big guys getting out of hand. So again, it seems like the best legislation for community banks would be, again, apply the common sense rule. Like, we're not contributing to the issues, so we should be regulated the same as the people that are.
It is our hope that ultimately the legislation brings a lesser burden and a more tailored approach to regulating our industry and our community banking focus. But the real benefit to date has been around the open dialogue and the communication that we've been able to establish with our regulatory agencies. So we're very pleased with the progress. It means good things for our communities. It has meant great things for the economic recovery that we've seen in the United States and specifically in our local communities and our small businesses. But there's more to come. There's more regulation discussion, there's more tailored approach to be looked at, and hopefully through this legislation and the interpretation of it, we will continue to see benefit.
First Guaranty Bank was founded in 1934 in Hammond, Louisiana. The bank is located in the downtown area of the community and currently has $1.8 billion in assets. One of the main drivers of the community in Hammond is Southeastern Louisiana University, which is home to over 15,000 diverse students.
What happened with Dodd-Frank and the subsequent rule writing and the CFPB is a lot of burden was placed on community banks where the problem didn't necessarily exist in the first place.
So what would be a regulatory burden, like the cost for First Guaranty Bank?
Oh, it's everything that we do. It's a huge thing, and I mean, it touches everything. You know, costs of having to compile all of these different reports, costs of all of the modeling that they want you to do, whether it's interest rate risk modeling, liquidity modeling.
I really don't know
how much
it costs to comply, and I don't really know a lot about what direction it's going in an individual institution or in a group of institutions, and it would be great to be able to tell them.
Yeah, and the other issue is, well, you're going to need some of it no matter what to protect everything. I think one of the things regulatory agencies are out in front of, and it is, I think, one of the most interesting but challenging risks is cyber risk. So I think they're doing a pretty good job being out in front on that and forcing people to keep moving forward. But we need to do that anyways, even if they weren't.
No one regulation breaks the back of the bank, but it's one more thing. And you know, it's like death from 1,000 nicks. It's one more thing. So when one of those little things can come off the pile, it's a success.
Security Bank has served customers from both Kansas and Missouri for over 100 years. In January 2017, the bank finalized a merger with 6 other banks. The merger resulted in an increase in assets from $792 million to $3.2 billion, making Security Bank one of the largest lenders in the Kansas City metro area. This increase created significant benefits for the bank, such as fewer compliance exams and the ability to implement stronger economies of scale. However, the merger also had its drawbacks. Security Bank's increase in assets launched the bank over the threshold for both fiduciary requirements and the Community Reinvestment Act.
For our HMDA reporting, the number of data fields that we're required to report reduced to 57 from a total of 109. And that was a significant cost saving with the compliance review time, the manual entry time, and just the data collection time for the HMDA law.
That would help. I think raising the currency transaction report, the limit from 10,000 to 20,000, I think would be a big help. Last year alone, Security Bank, we filed 4,199 CTRs.
I think what's burdensome is that we do a lot of analysis on our own in preparation for an exam, and we never know how that analysis is going to be viewed by the regulators until they're in-house.
What banks would like to see is real regulatory relief that allows us to compete in today's market. And although the small pieces that are being offered is a start, overall the regulatory relief needs to be much more substantial in order for it to really provide benefit for the banking industry.
People's Utah Bancorp is a publicly traded community bank headquartered in American Fork, Utah, and has been in operation for over 100 years. They are the largest community bank in the state and have 26 full-service branches operating throughout Utah and southern Idaho.
History of the bank, the thing that even attracted me, the company's been around since, was it 1913, I believe, so 106 years. Today, we're a publicly traded $2.2 billion financial institution with 26 locations throughout the state.
2018 was a record-breaking year for People's Utah Bancorp. Core net income increased from $28.1 million in 2017 to $40.6 million in 2018, an increase of nearly 44%.
This has historically been a very conservative organization in the first place. So the capital relief that came through Agrippa, we have always had excess capital anyway, so that really didn't impact us a whole lot. A couple places where it may have a bit, one would be on some of the electronic ease for our clients. We can open electronic accounts easier due to that. Some of the regulatory requirements historically on identifying your client, we can now take facsimile signatures as long as we identify who they are. So it's made that a little bit easier for us.
Probably the biggest area that we've seen a change is in the examination cycle, going out to 18 months for those banks less than $3 billion in assets. That has been a huge impact on the bankers. They love that. We as regulators, if the bank is in safe and sound condition, can go out to 18 months, and it saves on our manpower. We can concentrate on our efforts in other areas that are more important at the time. So those banks, I think seeing us every 18 months versus once a year is a little bit of a regulatory relief to them and has helped.
Whatever Congress can do to lighten our burdens as far as financial reporting, as far as other regulations go, would be very beneficial for us. That way we can focus on serving the community, and it's always a balance between compliance and providing what's required by the regulatory agencies and serving our customers, and finding that balance is the key.
First Bank is an American success story spanning more than 110 years. From humble beginnings in the small town of Scotts Hill in West Tennessee to the flashing lights of Wall Street in 2016, First Bank's story is a true legacy with an opportunistic future. 2016 was a milestone year where holding company FB Financial Corporation executed the largest banking IPO in Tennessee history. Steady growth began with branching and acquisitions across West, Middle, and East Tennessee. In 2014, First Bank opened their first branch outside of Tennessee, in Huntsville, Alabama.
First Bank is special in many ways. The fundamental thing that touches my heart the most is our ability to foster and cultivate relationships. We do that with our customers, we do that with our teammates, and we do that with our teammates across the franchise of First Bank. First Bank is the best place I've ever worked, and I would say that it just can't be beat.
Federal regulation is a burden for all banks, but weighs heavily on First Bank and other banks its size. This case study led us on a journey of learning about EGRRCPA and how its provisions will affect First Bank. Compliance is a large division of First Bank that takes hundreds of individuals to execute properly. In our study of First Bank and meeting with executives, we learned EGRRCPA was a welcome sight for First Bank.
The capital relief in particular will have impact on the structure of our balance sheet in some cases, and then provide capital relief in other pieces, specifically around the new community bank leverage ratio and the ability to, if we choose, to hold additional mortgage servicing rights.
Relief around the Volcker Rule, capital simplification, appraisals, and reciprocal deposits will definitely provide advantages for First Bank.
We also spoke with First Bank about the future relief they would like to see.
Leveling the playing field with credit unions and farm credit services would assist the bank, especially because their expense levels would be more in line with what we have to pay from a tax perspective.